Hello and welcome to Money Talk. In this episode, we've dubbed it 2020 Foresight. We ask three investment experts to gaze into their crystal balls. What does the next year hold for investors? 2019 has been a year of strong returns, but we're now more than a decade on from the financial crisis. Does the cycle extend further, or is 2020 the year in which the bears get the upper hand again? In a moment, I'll be talking to Merian's Richard Buxton, James Thomson from Rathbones, and Fidelity's Ayesha Akbar. But first, I gave our three experts 30 seconds each to say what they think will be the big market driver of 2020.
Brexit has clearly had a major impact on economic activity in the UK this year. So on the assumption that we do get a Conservative majority, the lifting of the Brexit uncertainty will be the single biggest driver of UK equities next year. I'm confident that we will get a Brexit bounce as a result of rising levels of consumer confidence, fiscal spending, and even business confidence is bound to lift a little bit. So I'm quite optimistic about the outlook for next year.
As a multi-asset investor, I think Chinese assets are looking pretty attractive relative to developed markets as we head into 2020. After the painful but necessary deleveraging campaign, the Chinese economy has improved since this time last year. While I don't think the targeted stimulus we've seen so far is likely to reflate the rest of the world as in cycles past, Chinese assets could certainly outperform. The fact that the Chinese assets are now being included in major equity and bond indices is also very supportive. And of course, any resolution to the trade dispute would be an additional tailwind.
Everyone keeps telling me that the US won't outperform this year. And yet it does, year after year. I run a global fund, so have the flexibility to go anywhere. But I think US equities will do it again in 2020. Despite the ugly politics, the US will make us money because that's where the growth is. US companies are growing profits 4 times faster than the rest of the developed world. And that's been true for the last 15 years. Some of these advantages are permanent. There are simply some world-beating, innovative, resilient, rock-star growth companies that the rest of the world doesn't have, and probably never will.
So, three very different views of where the value might be found in 2020. Let's dig into the detail now. Richard, I'm going to start with you. The UK has been massively out of favour in recent years, maybe for obvious reasons, but what's changed?
Well, you're absolutely right. It has been out of favour. Global investors have, it's been a pariah. The twin threats of a hard Brexit or a Corbyn anti-business government has just been too much for global investors. So the fact that we will A, get resolution to this, and this will have a positive impact on the economy, but B, you'll see the return of international investors. Sterling is already beginning to lift a little bit with the perception that the risk of a hard Brexit is fading. Sterling could be a very, very firm currency over the course of the next 3 to 5 years.
But has the uncertainty really gone? Because do we not just have another hard deadline at the end of next year?
It's a fair point, but I think for small businesses and for consumers, the fact that we've left is enough. Of course, major business investment decisions, you are going to want to wait till the end of 2020, get some clarity on the nature of the trading relationship with the EU. Clearly, the risk is most trade negotiations take years, that actually that does slip and we end up, for whatever the Prime Minister currently says, having to go beyond the end of 2020. But I think in the main, say for small businesses, for the consumer, just leaving will be enough.
Okay, let me bring Ayesha and James in here because you both run global funds. I wonder, James, maybe start with you. How does the UK feature in your global portfolio?
Well, I am starting to warm to the UK, and that's the first time I've said that in 3 years. I reduced my exposure to the UK from 25% down to 5% 3 years ago. I'm starting to warm, but I haven't reached boiling point yet. So there are, obviously the hard Brexit scenario is off the table, and that is good news for the UK economy. But we are entering a tricky transition period, and of course a trade deal to negotiate. And don't forget who the UK is negotiating with. You may not like the EU, but almost everyone agrees that they are the best trade negotiators in the world. And so I do think there are some tricky times ahead. But you can find very exciting ideas in the UK. There's some of the best companies in the world in the UK with very adaptable, innovative people running them. So you shouldn't ignore the UK, but you should also choose your battles in the UK. You may not want to invest in the FTSE 100. You may want to invest more in domestically oriented companies if you are more positive on a Brexit outcome. So choose your battles carefully.
Ayesha, so you're not just investing across different regions, but you're also a multi-asset investor. How does the UK stack up in your world?
Yeah, I think it is very, very interesting to look at, because I think you have to go back to the 70s to find this little interest in holding UK assets. And that's always a very attractive thing to look at. And I do agree that the UK is starting to look better with the outcomes that could happen with the election. Certainly there is going to be more certainty around what could happen. And I agree that at the moment, at least until the end of 2020, we have that spectre of no deal off the table. But I think ultimately it comes down to macro for me. And yes, the UK economy might improve, but when I compare it to what's happening in other parts of the world, the UK still isn't really the best place to be. So I'm still a little bit more cautious, but I do have a little bit more in the UK than I have had.
I think that by the end of 2020, the UK will be one of the faster growing G7 economies, because I think the Bank of England's been so wrong in its sort of gloom and doom for years now. Whereas actually the combination, say, of quite significant fiscal spending, we've got wage growth 3.5%. The manifestos all commit to significant increases in minimum wages. And you have got the resumption of some form of business spending. So I think we'll be coming from a slow pace, but I think by the end of the year we could be growing really quite strongly.
And all of that available at a pretty reasonable valuation because the UK is so out of favour. Okay, let's move on. Let's move on to a sort of more global picture. James, let's go back to you. You are keen on the US, and I know that you have a heavy weighting to the US in your portfolio. So just quickly, why the US? Why? Because we've got a difficult year ahead of us there as well, haven't we, with an election coming?
Yes, I mean, there are no simple answers when you're investing globally. But I think the beauty of running a global fund is that you do have the flexibility to go anywhere you need to go. And I can't help finding some incredibly exciting ideas in the US. In fact, I've taken my US exposure in my fund up from about 30% 10 years ago to 2/3 of the fund today. And that's because I'm finding some excellent growth ideas, sustainable, resilient businesses that I think can grow across all sorts of different economic cycles. But the backdrop is still uncertain in the US. You have very ugly politics that are at play. You have an election coming up, which is actually normally positive for markets. 18 out of the last 20 presidential election cycles have seen positive markets. So that could be, if history is any guide, a decent tailwind. But it's clear that sociologically the world is sick. But I think economically the world looks pretty sound. And there's perhaps no better evidence for that than the United States.
And the one thing that you didn't mention there, of course, which has been the big story this year and indeed last year, was the trade situation. Ayesha, I know that you've looked closely at trade. How important do you think that is? And also, who are the winners and losers from trade? China and the US obviously both impacted.
Yes, so I think it's fair to say that this year market movements have been correlated somewhat with sentiments around trade and a prospective trade deal between the US and China. So from a market perspective, it is pretty important. But actually from the economic side of things, it isn't actually as significant as people think. For China, they have been rebalancing, making it a little bit more dependent on their domestic and consumption side of things. And it isn't as important, again, for the US, where the US consumer, God bless them, they have been doing incredibly well this year, have been really keeping things going. So I think having a resolution to trade, or at least a phase one deal, as the markets would have it, would be very good, and it would certainly provide an impetus to a lot of emerging market countries, for example, that will benefit from a sentiment and China stabilization story, and that should percolate to other parts of the world as well.
Because it's been Germany that's actually suffered the most from the Chinese-US trade war, I mean, bizarrely, because they are such a significantly export-dependent country that they've actually had the worst collateral damage from this. So I think you could make a case for more interest in Europe next year if there is a phase one agreement. And one fully suspects they'll never actually get to a phase two agreement. It'll just be
I still think it's the biggest headline risk that we face. And let's just say all three stages of the tariffs were implemented. I mean, that would cost U.S. households about $1,000 each. So that would be a severe headwind for the U.S. economy. But interests are aligned on both sides. The U.S. and President Trump wants to win an election, and he wants to hold up the trade war victory in front of his election. And the Chinese, of course, want a deal too. In 2021, the Chinese will celebrate the 100th anniversary of the Communist Party. And I think they would quite like to put this in the rearview mirror, or at least have a truce ahead of that important year.
Mm. So you don't think, James, then that recession is likely in 2020? Is that correct?
No, I don't think recession is likely. I think that's really been taken off the table now by an accommodative Fed, Chinese stimulus as well, which of course helps the entire world. And so we have a lot of tailwinds. What people are concerned about is that we've had 10 years of expansion, and people are suffering from what I would call end of cycleitis, the unswerving belief after 10 years of expansion that we must be close to recession. But I don't think that's the case. I think there are too many tailwinds from both monetary and fiscal policy to keep us out of recession.
Okay, well that leads me on to the next topic I want to discuss, which is this apparent rotation that we've had in really since summer between the growth style of investment and the value style. And of course that is related to where we are in the cycle. Richard, maybe start with you. I mean, do you think that this rotation towards value, which is a reflection of improving sentiment towards the economy, has got legs?
I do, and since I am biased a little bit more towards the value than the growth, I hope it's the case. Clearly, there is a lack of inflation in the system, and so bond yields are going to remain low, even if, as I agree, we're not actually going to enter a recession next year. So to some extent, that is going to still support, the valuations of these very highly rated growth stocks. But the fact that there will be more growth around does clearly put a bit of a tailwind behind some of these more cyclical, industrial, financial companies that have so underperformed, on a multi-year view.
Mm. And Ayesha, your fund invests in other funds, some of which will have a growth bias and some of which will have a value bias. How are you balancing that?
Yes, if you allow me to be a little bit technical, I think if you want to see if growth is going to outperform or value is going to outperform, one of the key things I look at is the spread between the 10-year yields and the 2-year yields. And you really need that to start to go upwards, so 10 years start to look a little bit better.
This is the dreaded yield curve.
The yield curve, exactly. And I think until you see a meaningful move in that, it's difficult to see value outperforming on a long-term basis, but I do agree with Richard that you do have these shifts in market, and we are currently going through that. And yes, as sentiment improves, as people think that the world isn't falling off a cliff, then value could do pretty well. So I tend to balance out my portfolio. I do have managers that have a growth orientation. I use managers that have a bit more value orientation. Truth be told, I probably am a little bit more biased towards the value, simply because that differential is looking so large now that I think you really could see value do quite well.
James, you're not in that situation, I don't think, because you've got more of a growth focus in your fund. Are you anxious about that shift that's going on?
When investors buy growth stocks when economic growth is hard to find. And so we are in a period now of people feeling more optimistic about economic growth for next year, and certainly recession being taken off the table. So that does favor value-oriented strategies. And quite frankly, they deserve their day in the sun, because they're now at a 30-year discount, value stocks to growth stocks. I think the problem, though, is that for value stocks to work sustainably, you need a booming economy or a strong economy, because the value stocks from my early days at investing are not the value stocks today. Today's value stocks tend to be more economically sensitive, industrial companies, mining, energy, banks that benefit from a strong economy. So I think value could potentially outperform next year, but you have to believe in a strong economy for it to continue doing so.
Okay, so as ever, I guess a balanced approach makes sense. Richard, Ayesha, James, thank you very much. Plenty for investors to chew on there. Thank you to all three of our experts, and thank you to you for watching. Money Talk will be back in the new year. Goodbye.